So, this is episode number 96 of the Rohit Radio Show. Whenever I am investing in a company, whenever I am analyzing a company in the stock market, I am looking at certain ratios. And today in this video, I want to talk about 7 of those ratios and I want to discuss why I use those 7 ratios. Number 1, the gross margin of a company. See, the gross margin of a company tells me whether the company has got pricing power. If I look at the gross margin of a company for the past 10 years, year after year, if I see that the gross margin of the company is increasing year on year, that means the company is doing something right. The company has got pricing power in the market. It's a good sign that the gross margin of the company is growing. However, if the gross margin of the company is decreasing over a period of time, it means that the company is facing a lot of competition in that particular sector. So number 1 is gross margin. Number 2, the pre-tax operating margin. I look at the operating profit pre-tax. This does not include other income. So I look at that pre-tax operating margin. Now, pre-tax operating margin factors in costs like selling, general, administrative, research, development, and depreciation. All of these costs are deducted from the gross profit. You add interest expense as well. So what you are left over is the pre-tax operating margin. So if the pre-tax operating margin is increasing over a period of 10 years, year after year, it means that the company is managing its costs well. These are the costs that every business has to incur. And over a period of time, the company has been able to bring in efficiency in its processes. That is why I look at the pre-tax operating margin of the company. Number 3, net margin. Now, net margin can be used to compare any two companies in any two different sectors, because at the end of the day, I want to know which company makes a very good and a very healthy net margin. Net margin is basically profit after tax divided by the revenue. So an increasing net margin over a period of time for a company is a good sign. The company is managing its costs well. It is taking care of the competition well. And the company has some durable competitive advantage going on for itself. Otherwise, the net margin would have been reducing over a period of time. So I look at the gross margin, pre-tax operating earnings margin, and the net margin. Number 4, I look at the net receivables percentage. Basically, I look at the receivables on the balance sheet and divide that by the revenue. Now, the lower the net receivables percentage, the better, because this tells me that the company is collecting cash quickly after making the sale. Imagine that the company has net receivables percentage of 25%. So that's a bad thing, right? 25% of my revenue is yet to be received in the form of cash from my customer, which is a huge amount. So generally, I look at net receivables percentage, and if it is less than 5%, it's a good company, which means 95% of my revenue has already come to me in the form of cash. Only 5% is remaining, which can be recovered later. So the lower the net receivables ratio, the better. And I look at the trend as well for each of these ratios. If the net receivables percentage is decreasing over a period of time, it's a good sign. Number 5, inventory turnover. Inventory turnover is basically revenue divided by the inventory in the company. Some companies have an inventory turnover of 4. Some companies have an inventory turnover of 10. Some have 20. Inventory turnover basically tells you how many times the inventory is turning over in a given year. So for example, if it is 4, then every quarter the inventory is getting replaced by new inventory. So that inventory is getting sold and then you have new inventory. If it is 10, then 10 times the inventory is moving in the business. The higher the inventory turnover ratio, the better, because the higher the inventory turnover ratio, the faster the company is able to convert their invested capital back in the form of returns on their capital. So I look at the inventory turnover ratio and the trend of the inventory turnover ratio. it must be increasing over a period of time. Number 6 is the cash conversion cycle. I have discussed this in one of my earlier videos. Cash conversion cycle basically means how much time does it take the company to buy the raw material, then convert that raw material into finished goods, sell those goods, collect the receivables, and then pay the supplier. So this conversion cycle, the smaller the conversion cycle, the better. There are very few companies that have negative conversion cycle. Negative conversion cycle means I am collecting money before I have to pay to the supplier. Usually I am collecting money much later than I have to pay to my supplier. So I look at the cash conversion cycle. The narrower the cash conversion cycle, the better is the company. Number 7, of course, the return on equity. Everybody looks at this ratio, the profit after tax divided by the shareholders' equity. This basically tells me how much money have I put into the business, and in exchange for that equity that I have put into the business, how much am I making back? So anything about 20% or 25% is interesting to me, because if I'm investing 100 crore and immediately next year I'm making 25 crore, that's a great return on equity. If I invest that 100 crore in a fixed deposit, how much am I get? How much am I going to get? 5%, maybe 6%, 7%, whatever. But return on equity is a ratio that I look at. I also look at the trend over the past 10 years. Now, in some companies, what happens is, as cash keeps piling up, in spite of paying dividends, some companies have so much cash generating capability that as cash keeps piling up in the business, the equity keeps expanding, the base keeps expanding, and the profit doesn't grow as fast as the base is expanding. So you will find that the return on equity over a period of time is reducing because the denominator is becoming larger. But just because the return on equity is decreasing doesn't mean that it's a bad company. As long as the return on equity remains above 15-20%, it's a good business. So these are the 7 ratios that I look at carefully to analyze a particular business. And out of these 7, if I have to pick 2, I would choose the cash conversion cycle and the inventory turnover, because basically there are 2 ways to make money in a business. One is the narrower the cash conversion cycle, the better. Your inventory is turning over fast. Second is you have very high margins. So if your inventory turnover is small, that gets compensated by the high margins in the business. So that's what I wanted to discuss in today's video. This is episode 96. Thank you so much.